Property company REA Group's reported a 26% increase in revenue during the financial year to $1.2 billion. Net profit after tax jumped 19% to $384.8 million, but operating costs increased 34%, largely driven by the Mortgage Choice and REA India acquisitions. REA Group is majority owned by News Corp, which also owns Sky News. REA will pay shareholders a final dividend of 89 cents per share, and Ross Greenwood spoke with REA Group Chief Executive Owen Wilson a little earlier.
Oh, look, we think it can continue. You know, it was an exceptional FY22 result, as you said, driven by an outstanding performance by our Australian residential business, with revenue growth of 24%. But as we head into July, the conditions are still there for us to continue to perform. You know, in July alone, we had the highest level of listings since July 2015. We had our highest audience since March this year, and we delivered over 2 million buyer inquiries to our customers in July. So the market is still performing.
So is yours the type of business, though, that really doesn't require prices to be going up or down? It simply requires volume coming through for your business to be successful and to be growing?
That is right. We don't monetise house prices. As long as there are people who are willing to sell and buyers there to attract those vendors, our market can continue to perform. And we're going to see a few things that are going to help us with a softer market. Firstly, the number of people selling what we call off-market or non-advertised, that is absolutely going to come down, and they will come back on site as the market softens a little bit. But the other thing that applies is that the logic of buying the best products on the best site in a softer market absolutely hold true, and we get a sort of counter-cyclical benefit of a softer market from that.
OK, but then there's also the amount of cash which you have got. I mean, even after paying that dividend up by 25%, it's covered by 1.9 times the earnings that you've got. So you've got plenty of free cash flow there to be able to invest. You've done so in buying Mortgage Choice, the biggest mortgage broker in Australia. You've done so by expanding into India. You've done by going to Property Guru in the United States and have 17% of that. So you've got other areas where you're looking for future growth.
Absolutely. We have we generate a lot of cash flow. I think it's $488 million of free cash flow we generated this year. We finished the year with $248 million in cash on the balance sheet. And as you said, we're very lowly geared. So it does create opportunities for us to look at inorganic growth. And we've done that. We've done it very sensibly, I think, in India and financial services. Also, our data business. We acquired that a fair while ago, and that is really hitting its straps at the moment. It grew revenue 28% this year. So we will look at opportunities, and we're very disciplined in where we invest.
OK, just one thing about going overseas. So many other Australian companies in the past have done so and failed, licked their wounds and had to come home. In your case, why is it that you think the model that's been created here in Australia can be translated so well in places like India that you can take similar models into the United States and other parts of the world?
So much of what we are good at here in Australia at REA can be transported. Things like our consumer experiences, the way we design our app, the way we display properties, things like SEO capabilities, which drive a lot of our audience organically to realestate.com.au. These things can be transported, and we believe, being one of the best portals in the world, we can export that IP, so to speak, to places like India, Southeast Asia and North America.
Take me to back here in Australia. One issue that is there with every other business, and it's in your outlook statement as well, is rising costs here in Australia. Just tell me about the impact of those rising costs, the pressures that you're under to try and contain those, and certainly to have them not growing faster than what the actual business and the revenues are growing.
We are fortunate in one respect in that primarily our main cost is people, and we've given guidance for FY23 that our cost growth in Australia will be high single digit, and that is a combination of wage inflation, and we've just put through our FY23 wage increases at below the level of inflation, but also we've got the impact of our headcount investment we made in the second half of FY22 coming through. So with the combination of those two things will give us about a high single digit cost increase in FY23. But because it's people, we also have the ability to flex it up and down. We have a fairly sizable part of our workforce that is flexible. They are outsourced, and so we can turn that on and off as we like. We also always have vacancies in our business. We do have turnover, and so we can slow the rate of recruitment and also control our costs that way. So we're pretty fortunate in that regard.
Okay, and just tell me, in the past 12 months, has it been hard to get the workers? Are you trying to get them back to the office, or is it one of those businesses where you can do it remotely?
We're very lucky in that regard as well, in that when COVID first came, the move to hybrid was pretty easy for us, in that everyone in the business has got a laptop, a mobile phone. We were all on Zoom anyway. We've moved to effectively a permanent hybrid work model. People are coming in sort of 2 to 3 days a week, and we do it on a team-based way, in that the team decides what days they want to be together in the office. Working remotely is very easy for us in what we do, and so there's been sort of no impact on us in terms of productivity from people working from home.
And just a final one for you. Just give me a hint about the future for house prices in Australia. You've already said it's actually about turnover in regards to your business, but what about the future of house prices? Does that actually change any of the dynamics inside your business? Definitely,
house prices, we think, will moderate as further interest rates come through. My view is we need to keep it in context, though. If you look at where we are at the moment, if house prices fall 5% from here, it really only takes us back to where we were in August last year, and a 10% drop would only take us back to May last year. So effectively, it's taking the froth off the top of the market from the imbalance we had last year between the sellers and the buyers. And yes, you are seeing the markets that ramped up really quickly, they're having the largest comeback in terms of prices this year. But in terms of our business, it's really about, are there going to be buyers in the market? And we think there are some fundamentals in our market, such as the record low unemployment, the high levels of household savings, and the return of immigration are going to keep that demand there, which hopefully will keep the turnover in housing stock going.
Owen Wilson, Chief Executive of REA Group, many thanks for your time today.
Thanks, Ross. Really appreciate it.